We're analyzing Novo Nordisk, stock ticker NVO, to see if it's a great business on sale. This analysis is going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Novo Nordisk. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Novo Nordisk for your stock portfolio. Before we get into these valuable metrics, let's understand Novo Nordisk stock performance. Right now, Novo Nordisk trades for $161.73 per share. Year to date, their stock price is up 17.5%. Right now, Novo Nordisk pays a 0.78% dividend yield. Their average dividend yield is in addition to their returns in their stock price. In the last 5 years, the company is compounding at 27.5% annually. In the last 10 years, they're compounding at 16.5% annually. Going back before the global financial crisis, over the last 18.5 years, Novo Nordisk is compounding at 20% annually. They're one of the top performing stocks over this time. The company's stock price is up more than 30 times. They're beating the market average. Right now, Novo Nordisk trades $10 below their 52-week high. The company's up more than $60 from their 52-week lows. Novo Nordisk is a huge business. They have a $360 billion market cap. But the burning question is, why should we be paying close attention to Novo Nordisk? With roughly 1/3 of the global branded diabetes treatment market, Novo Nordisk is the leading provider of diabetes care products in the world. Based in Denmark, the company manufactures and markets a variety of human and modern insulins, injectable diabetes treatments such as GLP-1 therapy, oral anti-diabetic agents, and obesity treatments. Novo also has a biopharmaceutical segment, making up around 10% of revenue, that specializes in protein therapies for hemophilia and other disorders. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Novo's average return on capital in the last 5 years to be above 14%. The average company earns about 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Novo earns huge returns on capital that are insane compared to most businesses. Their lowest returns came in 2021 at 58%. When these are averaged out, Novo earns 73% returns in an average year. That's 10 times better than a typical business. This is an insane check on metric number 1. Metric number 2, we're looking for growth to go with their high returns on capital. We want to see 5-year revenue, net income, and free cash flow growth. All three need to be up. This metric's all or nothing. We'll include their last 12 months worth of numbers in our growth calculations. In this time, Novo's grown their revenues by 54%, their earnings have grown by 50%, and the company's free cash flows have led the growth charge. They're up by 89%. This is strong growth across the board for Novo. A second check here on metric number 2. Metric number 3, we're looking at Novo from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We learned their earnings or their net incomes have grown by 50%. At the same time, Novo Nordisk has bought back 6.5% of their shares outstanding. With this earnings growth and these share buybacks, this is a check on metric number 3. We're perfect through our first 3 metrics. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is a similar result to our last metric. Novo has grown their free cash flows. With their added share buybacks, Novo's grown their free cash flows per share. This is a check on metric number 4. We have 4 checks through our first 4 metrics. Can Novo keep this up? But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Novo Nordisk apart, which is having these without using a lot of debt. Metric number 5, we want Novo's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In this time, Novo's used a small amount of debt. They ended last year with $300 million in net debt. Right now, they actually have $328 million in cash on their balance sheet. At the same time, Novo's generated $35 billion of free cash flow. That number is huge compared to their debt position. This is another massive check on metric number 5. They generate a ton of free cash flow in their business. Flawless through our first 5 metrics, does Novo Nordisk have what it takes to be a perfect Select 6 stock? We'll find out right after we cover our bonus. As our bonus, we're looking at Novo's dividend profile. Right now, Novo pays a modest 0.78% dividend yield. We want their dividends to be supported by their free cash flows. That's been the case in all 5 of these years. Not only has Novo grown their dividends over this time, they've also grown their free cash flows and they've decreased their dividend payout ratio. Novo's dividends have been supported in all 5 of these years. They're supported today. It looks like their dividend payouts are in good shape for shareholders. This is a check on our bonus. The big metric of them all, metric number 6, we want Novo's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Novo Nordisk. Right now, Novo has a $360.5 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Novo similar to it being a private company. In the last 5 years, we learned that they've generated $35 billion of free cash flow, meaning they generate just over $7 billion of free cash flow in an average year. When that's divided by their $360.5 billion enterprise value, it gives us a 1.98% average free cash flow to enterprise value yield. On a current basis, Novo generated $10.1 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get around a 2.8% current free cash flow to enterprise value yield. Both of these are below the yield of the 10-year treasury, meaning they're below our risk premium as well. Coming in all the way on metric number 6, this is our first and only X of the day for Novo. Don't just throw this business out. We still need to estimate their fair value per share and give our final rating to the business. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Novo Nordisk, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Novo's current free cash flows and using historical assumptions to grow these into the future. Novo's been a very predictable business in its past. That better informs our assumptions, but it's no guarantee for the future. Assuming they grow their free cash flows at 11.5% annually for the next 10 years, then assuming in the following decade that this growth rate is cut in half and these grow at just under 6% annually, if we add in their tangible book value, which gives an estimate of their net worth, if we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of Novo's fair value per share is around $56. That's down a lot from their current stock price. Keep in mind, their business predictability could change into the future. This is also an estimate. This 15% discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes both stock price appreciation and any dividends the company pays shareholders. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Novo Nordisk, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for this business. What are they? Looking at the factors supporting a long thesis, number 1, semaglutide is also being studied in liver disease, heart failure, and Alzheimer's, and Novo could achieve a strong share in these nascent markets. Number 2, with a solid portfolio of GLP-1 products, including Ozempic and Rybelsus, Novo is well positioned to defend its formidable diabetes market share. Number 3, the increased prevalence of obesity and diabetes should drive continued mid-single-digit demand growth for insulin therapies, and Novo's new obesity therapy, Wegovy, is likely to significantly expand the obesity treatment market given its strong efficacy. But we'd be remiss if we didn't cover the negatives of the business as well. Looking at the factors supporting a short thesis, number 1, Novo's obesity drug, Wegovy, had a slow launch due to supply constraints, and Mounjaro could launch in 2023 to 2024 in obesity with a potentially superior profile. Number 2, Novo's Victoza and Ozempic have made GLP-1 therapies a key part of the firm's growth, but oral GLP-1 Rybelsus has had a slower uptake, and Lilly's new approved Mounjaro provides strong competition. Number 3, Tresiba's strong profile in the long-acting insulin market hasn't been enough to defend it from US pricing pressure due to competition from Sanofi and Lilly. Biosimilar insulins have weighed on category pricing since 2017. There you have it for a balanced perspective of some of the qualitative factors of Novo's business. Now it's time to give our rating. In analyzing Novo Nordisk, we learned this diabetes market leader has phenomenal financial results. They earn insanely high returns on capital. They've grown strongly in the last handful of years. They've also bought back shares. The company has a small cash position and they generate a lot of free cash flow. They've also comfortably supported a growing dividend using their free cash flows alone. Again, this analysis is not financial advice. Novo Nordisk's free cash flow to enterprise value yields don't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if today's valuation multiples are the same 20 years into the future, based on those assumptions, if you want a 15% rate of return, an estimate of Novo's fair value per share is around $56.50. Novo last traded at those levels in spring of 2020 alongside the broader market crash. You need to be patient. Looking at all the factors of our analysis, Novo Nordisk looks like a strong candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Novo, and let me know what business to look at next in the comments below. Thanks for learning about Novo Nordisk with me, and have a great day.